The whole idea in real estate is to buy a business where you're going to try to exit that asset at some point in time. You want to crystallize the equity either through a refinance or through a sale and repurpose that equity into another asset.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Gino Barbaro. Gino is an investor, certified money coach, entrepreneur, and podcast host. As an entrepreneur, he's grown his real estate portfolio to over 1,900 multifamily units and $450 million in assets under management. And in just a minute, we're going to speak with Gino Barbaro about multifamily investing and money coach. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Gino Barbaro. Welcome back to CREPN Radio.
Darren, it's a pleasure to be on, brother. How are you?
I'm great, man. I'm looking forward to our conversation. You and Jake, you guys have been regular. Well, I can't say regular, but you've been on multiple times and have enjoyed all of our conversations and looking forward to catching up. And before we get going, if you could take just a minute and reacquaint with the listeners and let them know a little bit about you.
Well, Darren, the first thing I realized, or I found out a couple minutes ago, was you're the one who turned me on to podcasting. I think you're the one who said that we were interviewed by you, and Jake's like, hey, we need a podcast like Darren. So I guess it's all your fault that I've been podcasting for the last 10 years.
I don't know about all my fault. There was a lot of enthusiasm on the other end there. So.
Listen, I love the podcasting space, and I got into real estate back in 2011 with Jake. I mean, Jake and I partnered up. I had been buying smaller deals before then. I was the mom and pop landlord. I was the restaurant owner, the one shop. I was the guy who had the job, who was just stuck in the rat race. And there's nothing wrong with it. I loved it until I didn't love it anymore, until I had 4 kids and I had a lot of mouths to feed at the time, right? So I'm like, I can't keep doing this. I'm working harder and I'm making less money. What do I do here? And Darren, honestly, what I did is I just took a step back and I just saw what other people who were wealthy doing. They were just investing in real estate and taking their time and waiting for real estate to go up in value and buying assets that actually cash flowed. And that's what I did with Jake. We started in 2011 buying deals. It took us 18 months to find our first deal. Then after that, we bought our second deal 3 months after that. And then we bought our third deal 6 months after that. And for me, it was multifamily. I just wanted to focus on multifamily because I already had the job. I was already, quote unquote, fixing and flipping pizzas. I couldn't do that with houses. So I figured if I could buy 1 or 2 deals a year, do it on the side, eventually in the next 4, 5, 6 years, I'll have enough units where I can leave the restaurant and I can go into real estate full time.
I love the beginning story. And one of the things you touched on there, which I think I know I've been guilty of not doing properly, is cash flowing assets. I bought them. I mean, they penciled in that they zeroed out, but if anybody sneezed or anything didn't, we weren't building up cash reserves in the beginning when I first started. And I'm just curious if you had similar experiences, or were you always able to find cash flowing positive to where you were building up reserves when you started?
Well, let's just zoom out
Okay.
for a second. For me, starting out, cash flow is great. Cash flow gets you out of your job. Now let's zoom in. Equity keeps you out of your job. So this whole idea of cash flow is going to make you rich, hey, it does. It pays the bills. I have a cash flow snowball machine right here. But do not discount the people who are buying assets in California, or well, California doesn't cash flow. But California does create a lot of equity at their assets. So you need to understand what assets you need to be buying. Because if you're a professional, if you're out there and you don't have time to deal with these properties, possibly you're buying a couple of single family homes. They may not cash flow. That's okay. But 5 years down the road, when you paid $400,000 today, and in 5 years they're worth 600,000, you just made a 50% return on your equity. So understanding why you're investing is really important. Now, for us, it was just a selection. To answer your question specifically about cash flow versus equity, we were in a market where we could cash flow and there was a little bit of equity appreciation. But being very clear with your goals is really important. I wanted in the beginning to create some type of cash flow so that cash flow every month could replace my income coming in from my restaurant. And then from that point, hey, we're going to start buying other assets that may not cash flow as much, but there's a ton of equity on the back end where we can either refinance out, we can sell it out, repurpose it, and continue to buy more assets. The whole idea in real estate is to buy a business where you're going to try to exit that asset at some point in time. You want to crystallize the equity either through a refinance or through a sale and repurpose that equity into another asset.
I love the way you summarize that, because I think that was one of the ahas I had. uh,
Mm-hmm.
More recently was the equity build, and like you mentioned, I'm out here in Oregon, and the West Coast is definitely more of an equity play, I think, than not as
Yes.
much as like California, but I mean, clearly there are markets I know back in the Midwest where I'm from, where you can cash flow, much better, but I don't know that you get the equity build,
Mm-hmm.
like you mentioned. And that's all a function I think of, or the way I've been able to break it down is there growth and is there demand, investor demand specifically, and that's why I think you see
Mm-hmm.
a lot of the big institutional funds. They're looking for A-class properties in markets where they know they can exit. There's an exit, and that's all driven by demand, meaning there's somebody behind you wanting to buy it. Versus if you go out in
Mm-hmm.
the Tules and you buy something that cash flow is great, and you find out that there's nobody else that wants it.
Yes.
And you may get to keep it forever, or sell it at a discount, kind of thing.
That's an
And
excellent point, Darren. I don't want you to move off of that point because what you are describing is, do you have an exit strategy? Now, there is nothing wrong if you're going to buy something in Timbuktu and hold it for the next 20 or 30 years, understanding that's the proper exit strategy. But if you're trying to buy an asset in a tertiary or a very small market with no professional property management, there's very few unbuyers. Now, you may get caught up in a market cycle like there was 3 or 4 years ago, where all of a sudden a city like Macon, Georgia, was trading at 4 and 5 caps. That's rare. That's uncommon. That's just institutional money chasing yield. At some point, it's going to reverse, and it actually did in that market. So understanding what your exit strategy is, if you're looking to buy an asset in a market like LA and you're catering to institutional investors, but then you say to them, "I'm going to buy something in Omaha, Nebraska." They're going to be like, why Omaha? Omaha's not sexy. LA is sexy. And that's the problem. That's why cap rates are lower, because there is more demand in that market. Assets trade a lot quicker. That's the understanding. That city is actually growing, where a tertiary city may not be growing. Although, if your model is to buy these assets, to operationally manage these assets, hey, and in 10 years, you've gotten cost segregation, you've gotten the principal pay down of that asset, you've made some significant, wealth in that asset. But just understand, going in eyes open, what your strategy is, and make sure that you're picking the right market to really allocate and really hit upon the strategy that you're trying to accomplish.
yeah, no, I love that. And strategy, I don't know that I've always had a strategy. I think that initially it was I just wanted to get in. I didn't fully understand all the levers or how
Yes.
to play the game. And I think that the important thing is you got to get in somehow, whether you get in solo buying a single family, try and figure it out, or you get in as a member of a syndication, or partner up with somebody or whatever. But somehow
Yes.
you have to get in, because it's really easy to stand on the sidelines forever and then analysis paralysis kind of thing. But to actually commit, get the butterflies, and be nervous, and having had worked the numbers backwards and forwards and up and down and trying to figure out how to make it work, eventually you have to pull the trigger and get in. And I've always believed that there's no lesson like actually, live bullets. I mean, when
Yes.
things are happening, as opposed to, you can think about it and think about it and think about it. But it is get in the game, kind of thing.
Hmm.
Um, so I want to ask you. So we're talking a little bit about the different, or I guess some of the benefits, or the well, the ways to view an asset, whether it be a cash flow or an equity appreciation. When you guys first started, and if I remember right, you guys bought, was it some sort of mom and pop thing, like a 14 unit, or I can't remember how many doors it was, but I remember Jake
Hmm.
was the rent collector the first time,
Yes.
and I remember some story about a guy in his underwear or something like that.
Yes.
And but anyway, the that was kind of like a springboard to get you guys growing or going,
Yes.
and
Hmm.
and then immediately you got validation in the marketplace with others were taking note of, like, hey, these guys are buying properties, and all of a sudden people are coming to you as opposed to you having to find
Yes.
things. So tell me just briefly, if you could, from where you started, the class of property. Was it all value add? Was it capital intensive value add, or was it management value add, as to what you're looking at today in 2026?
Let me preface that question by saying that I had an investment life before Jake, and I had an investment life after Jake. The life before Jake is what you were describing. I need to get in. I need to find a deal. I'm looking for IRR. I had no map. I had no process. Fortunately, I went and took several mentorship programs before I met Jake. So I really learned the business. I started creating our own map. And then when Jake and I got together, we created the buy right, the finance right, and the manage right, which is I've really positioned it now to buy right, operate, and exit. We started creating and working with a framework, right? That's the whole idea, is to have clarity. We don't lack the motivation, we lack the clarity. And when I was before Jake, I was just looking for anything. When we started with Jake and myself, it was a function of the market cycle. So people have to understand the real estate cycle, market rate and market cycle, interest rate cycle, whatever you want to call them. At the time, the properties that we were buying, the material value add properties, aka those mom and pops that were crap holes. That's for lack of a better word. They were really cheap. They were really inexpensive. Cap rates were really high. So at that part of the market cycle back in 2011 and 2012, these smart investors were buying these assets at 25% of replacement value. So that made sense. And we started buying these mom and pops. And as the market cycle lengthened in 2015, 2016, 2017, there was a little bit more of a flight to quality, but we still preferred these B and C properties because there was an ability to buy these assets, to reposition them, and to actually cash flow with these assets. Now, if you're buying newer assets, the A's, that strategy is more of a preservation of wealth. Hey, I'm going to buy this asset at a 3 or 4 cap. I don't have to do that much work. They're a little bit easier to manage. And 5 years down the road, the whole asset's going to appreciate. Rents are going to go up. We hadn't gotten to that point. We were still back in 2018 and 19 buying those value add properties. But as the market length cycled, as the cycle lengthened back into 2021, we had seen that C properties all of a sudden were getting very expensive. Why am I going to pay a 4 or 5 cap for a 1960s C property when I can pay a 5 or 6 cap for a 1990s B property? So our whole mantra started shifting. It really is a function of the market cycle, and where we are currently right now, we're buying assets that are newer vintage builds because all of a sudden you have these older assets. And if you go online right now and type in LoopNet, wherever you are, whatever market you're in, you're going to see a lot of old assets popping up because there's a lot of crap that's on for sale right now because those properties, they overpaid for them. They were bought with negative leverage. You're buying an asset at a 4 cap with a 6% interest rate. Not a good idea long term unless you can materially add value to that asset. That asset also has a lot of capital repairs, a lot of deferred maintenance, which a lot of operators didn't take into consideration because they weren't in the business. They were just raising capital and trying to flip these assets. So, to answer your question, older assets, when we first started out, now we've transitioned into newer assets. But Darren, there is a caveat. If we can buy an older asset at a really good price and be able to, turn that asset and still be below replacement and cash flow, we'll do that. But what we've been focusing on is newer assets in this part of the market cycle.
Yeah. No, and I think the opportunity, we talked about market cycles, but I mean, just a little bit I've been talking with people about just where we are in the cycle. A lot of
Mm-hmm.
debt's starting to mature. People are either facing a refi with higher interest rates than what they originally got in, or they want to exit, or they're underwater, or the
Mm-hmm.
value's not there. So I think one of the interesting things about real estate is, unlike a stock where you can get in and get out, fairly easily,
Yes.
there's a time commitment, and depending on what your plans are, your exit strategy may change based on what you need or what you want, as well as the what you get when you exit may change.
Yes. And
Um,
that's a benefit for real estate, in my
right,
opinion. Because
right,
if you can't hit the button, your Bitcoin at 120K, you can hit the button, get out, right? That's
right,
great. The liquidity is great. But that really hurts the vast majority of Americans from creating wealth because they typically exit too soon. How many
right.
people do you know own Amazon stock from 1999? Very, very,
Yeah,
very few. And it was right of them. If you've made 180% on a return, you probably exit. But could you imagine if you didn't exit and you just sat there? You know how many multiple millions of dollars you'd have? Not because you're any smarter, not because you're any wiser. You just held the asset and said, you know what? I don't need the money. Let that money compound. That's the power of real estate when you understand that, yes, you can exit. And if you know there's a time to exit, take some chips off the table. But repurposing that money into different investments. That's the difference between the wealthy and the rich. The wealthy will exit when they understand. They'll take some chips off the table, but they'll repurpose that wealth. The rich exit, take a tax hit, and then actually repurpose that into toys or into luxuries, and that money is gone. So that's what I love about real estate. I can't exit as quickly as any other asset, and sometimes it allows me to think in longer term.
yeah. No, it definitely. I'm a big fan of the long road with real
Hmm.
estate. I know. A lot of people I've talked with about syndication. I feel like they have more of a kind of a stock market mentality in that, get in, let's grow it up quick and exit. And
Yes.
and I'm going, okay, well that's one strategy, but I think over the long haul, having the tenants pay down my mortgage, the appreciation that the market brings, rent
Yes.
increase, and originally when I got in, my goal was to have the tenant pay off my mortgage and have a free and clear property. I hadn't even
Yes.
considered appreciation.
Yes.
I didn't even understand that.
Yes.
And but again, uh, there's lots of ways to come at this. There's lots of different, there's opportunities for everybody. But I think the
Mhm.
important thing is to understand, you know, what you've kind of identified is, what is your strategy? What is your
Mhm.
plan? And are you going for cash flow, or are you going for equity? And get that, have an understanding, but you got to get in. You got to get in. Period. In order to
Mhm.
play the game. So,
Do you
in fact,
mind? Do you mind if we touch on the syndication model for a quick second? Because
yeah, 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 yeah.
I'd love to unpack that for people because syndication is a wonderful tool. It's a tool for an investor to get into a larger deal. And it's a tool for a general partner or for somebody putting together a deal to go out and to pool capital where they couldn't get into that investment. Now, the problem that I have with syndication is it is a fix and flip kind of strategy, but it's okay to have that where you have a 150 unit syndication going on. You create wealth from that. You take that money out, and then you can go out and buy your own 10 or 15 or 20 unit asset. Why can't we be doing these both in conjunction? I think that's part of the market cycle as well. Over the last 4 or 5 years, syndications, it lent really well, the market cycle, because asset prices were lower. The cost of capital was a lot cheaper. As these things started to shift, the syndication model became a little bit more challenging. Just understanding that the syndication model is really predicated on getting in, adding value, and then flipping out, crystallizing that equity. That's what the general partnership is wanting to do. And unfortunately, most limited partners don't want to stay into a deal more than 3 or 5 years. They want their capital back also, which doesn't make sense to me, but that's the whole idea. So if you go into the syndication model, you need to understand that it's going to be a shorter time horizon. But if you want, you can go in by saying, hey, I want to hold these assets long term. Let me focus on investors that understand that power. It's going to be harder for me to raise money from people saying, hey, I'm going to hold your money for the next 10 or 15 years. But we will have a liquidity event probably in the next 5 or 6 where you get the vast majority of your capital back, let's say, and then we continue to hold. Those investors, it's harder to pitch that. But if you find the right ones, that's where I like the syndication model, because I don't want to go out and buy an asset and do all that work and then after 3 years exit that asset and have to try to do it all over again. I'd rather want to buy one or two really quality assets a year, focus on them, focus on those operations, make that asset really pristine, and continue to hold that asset long term, than go out and fix and flip. That's just not my mentality. Once again, we fall on that concept of what's right for your model. Where are you in the journey? Because if you're younger, you're going to have to create equity, and syndication is an excellent way for you to create equity. If you're older and you look at the model and say, hey, I want to hold these assets longer term, I want to partner up with people who have that vision as well, then I think for me that syndication model works well for the older investor as well, if they take that kind of mindset.
Yeah, I agree. And speaking of which, I know the last time I spoke with you and Jake that you guys were not syndicating, but I kind of have the sense that you maybe have done, or have you done some syndicating?
That's a great question. And I left out during the story of Jake and myself as we were buying assets. In 2016, we had just acquired 303, it was 282 units of seller financing. It was an $11 million deal at the time, which has exploded in value, but we didn't have any of our own money into that deal. We didn't have any more money. So the next deal, a couple of deals were like, hey, everyone's talking about this syndication thing. What the heck is a syndication? So we wanted to learn it because we wanted to teach the Jake and Gino community. So we decided, let's start syndicating deals. We syndicated 3 deals, 2018 and 2019. And they were great. We loved them. The only problem was it's just what I'd mentioned to you. There's 2 reasons. I'll give you the 2 reasons why we just didn't like the syndication model. The first reason was we had to exit these deals in 3 to 5 years. We're like, we're doing all this work, we're creating all this equity for LPs, and then we got to get out after 3 to 5 years. And the second one was we just didn't want to work with investors. We had over 100 investors on our database. It's another business. We have the property management, we have the asset management, now we have the syndication business. And it was great because it actually bridged the gap. We were able to close almost 400 units with syndication. We raised over $10 million. We had an IRR probably blended of over 25% on those 3 deals. So we did make a good amount of money, and our LPs made a good amount of money. But then after the third one we exited back in 2022, we said to ourselves, let's not syndicate anymore, because we have to go out and constantly talk to our investors. We have to constantly source deals. We may fall into the trap of the risk where, oh, we have this capital. We need to replace this capital into a deal that may not fit our parameters, but hey, the money's there. We got to do it. So we just said to ourselves, let's pause on the syndication. Let's just focus on in our own capital, because now we have the resources. We've been refinancing deals. We have our own capital in our own portfolio. We've sold a couple of deals as well. So for us, it was a great bridge. And for us, once we realized we don't want investors and we don't want to kill the golden goose, it was just a decision to start just looking at deals with our own capital.
Yeah. Well, and I appreciate both sides, and I was kind of curious. I knew because you guys are vertically integrated,
Hmm.
or you are and you were and you are, right? And are you
Yes.
still primarily focused there in Tennessee? Is it Knoxville, or I can't remember?
Yes.
Okay.
And that's the issue. The issue is it's a positive one and a negative one, right? If you're looking holistically, big picture, being vertically integrated is great. It's incredible. We focus on a metric called profit per unit. That's really the real reason why we got out of syndication. We want to focus on the profitability of each unit that we own. And with syndication, we don't own the entire deal. We only own part of the deal. And when you're vertically integrated, you cannot scale to the moon because you have to hire employees. We've got 90 employees on the property management team. If we decide to add 1,000 units to our portfolio, you're talking, I don't know, you're talking probably another 30 or 40 employees you have to hire in a short period of time. And it's very challenging. So for us, we didn't want to outgrow our infrastructure. So we're like, okay, let's look at what our goal is. Our goal is PPU, profit per unit. Our goal is to be within 3 hours of Knoxville. So that limits the amount of deals we can look at. That limits the amount of growth we can look at. So for us, being vertically integrated works really well for us. For some other groups that want to grow and want to add units and want to scale and want to go to different parts of the country, it that works well for them. But for us, that wasn't the model.
Yeah. No, I've always loved your model, the wheelbarrow profit, and
Hmm.
just the kind of vertically integrated, and then having a geographic area that you focused on, and
Yes.
all that. Um, I want to ask you a little bit about Money Coach,
Mm.
because I know you've spent a lot of time and you do a fair amount of coaching. Tell me kind of, or kind of give me the overall, and then kind of give me some details on how you work with people, and I assume it's in an effort to become a real estate investor. Is that accurate, or
It's to become whatever you want to become.
okay?
If you're working in the business world and you want to scale your business and you're having problems, if you want to buy a real estate property and you can't do it, how do you do it? The reason why I got into money coaching was after years of doing Jake and Gino, we owned the company for probably 7 or 8 years. I had seen some students come in who had no business in investing and buying deals. They were buying deals. Like this person's young, he has no credibility. She's never done a deal before, but she's closing deals. And then I had these individuals that had 7 figure net worths. They were good looking, they had everything, but yet they're complaining and they're not doing any deals. And it finally dawned on me. I had met a woman named Deborah Price. She owned the Money Coaching Institute. And it was just like an epiphany for me. And I should have known this sooner because I was a life coach. But what I realized is that a person's patterns, their behaviors, and their beliefs are all created during childhood or during the young formative years. We have these financial flashpoints, these memories when we're young, where all of a sudden something happens to us. There's emotion around money. It happens. And as an adult, we start falling back on these unconscious patterns. For me, as a child, when I was 5 years old, I went to the store with my grandmother. We couldn't afford something. And I remember her saying in Italian, Tesoro, we can't afford it. And I remember that left an indelible mark on me. Like, I can't afford it. We don't have the money. I developed a scarcity mindset early on. I became an amazing saver early on. I wanted to avoid risk at all costs. So that brought me into the real estate space. And it was awesome for me because I started challenging those beliefs from life coaching. I started saying, well, do I have to believe that? It's funny because you say it takes money to make money. Yeah, it does. But is it your money? No, syndication and creative financing, you can use those tools and it's not your money. Well, money doesn't grow on trees. Well, actually, if you look around, there's a crap ton of money in floating around, and maybe it doesn't grow and you can't attract it, but it's all over the place. I started looking at all of my behaviors and my beliefs that I really inherited and I got from childhood, and I brought them into my adulthood, and I saw the damage that it was doing to me, to my behaviors. And once I was able to uncover that and to really go back and to look at those events and to try to, I don't want to, we can use the word heal, right? Because they are traumas to you. When you're a 5 year old and you can't reconcile why you can't buy something, that leaves an indelible mark on the way you view money. I mean, how many times have you heard people say rich people are evil, rich people are greedy? Well, I'm not here to say whether it's true or it isn't true. But if you believe that rich people are evil and money is evil, and you're trying to open a business, I can give you every strategy known to man. I can tell you exactly what to do. I can also guarantee you that from the behaviors that you will exhibit from those thoughts, you will not become a successful business owner. That's how powerful it is. And it's so obvious to me now. I wish I'd known it years ago. And that's why I'm so in love with this money coaching concept because I love to work with couples, husbands and wives. When husbands and wives fight, my wife and I, when we fight, is it about money? It may be about money, but that's not the cause. There's always something underlying beneath that argument. And that is what I love to talk about. You love to talk about those couples where the husband grew up in one situation, the wife grew up in another, and all of a sudden they get together. They have different views on money. One loves to go out and party, one is afraid because they grew up in a single family household. You get together, and all of a sudden you can see the conflict arise. And just having them have that conversation and saying, this is what happened to me as a child. How can we reconcile and how can we get together on the same page? That to me has been it's been life changing, even for my relationship with my wife and my kids.
Yeah. No, money is definitely it gets real in a hurry.
Mm-hmm.
When you get married, you get a um, somebody else you have to justify your behaviors to,
Yes.
and what do you mean I can't? Yeah, but I always do this. So, and I think it's a healthy conversation to make sure you're on the same page. Because if
Mm-hmm.
you are going to try and row the boat in the same direction, you'll go a lot further than if you're, one's pushing, the other one's pulling kind of thing. And,
Yes.
and, but, all part of the fun of joining forces. And,
Mm-hmm.
it's been a great thing for me. As you were speaking, I was thinking back about, some of those early days of marriage and just trying to explain, some of my screwy thoughts on money and stuff and how they didn't add up and like, you know, but it's definitely, it was very grounding and it's helped us to go forward and
Yes.
accumulate and do well. Um, Hey, Gino, if we could, I'd like to shift gears here for a second.
Sure.
By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If we cannot avoid the risk, we look to see if there's a way we can minimize the risk. And if we are unable to avoid nor minimize the risk, we look to see if we can transfer the risk. And that's
Mm.
what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your tenants, the market, interest rates, politics, whatever it is you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Gino Barbaro, what is the biggest risk?
That is an excellent question. I can look at risk from my own perspective of my life as when I look at risk, what is the risk of not doing something? If I had been at the restaurant back in 2008 and I would have said, you know what, it's too risky. I've got a nice little small business. I'm hanging out. I'm doing okay. And that's what a lot of people out in society right now, they have a comfortable job. They're not looking around. They think that there's no risk involved in that. Whatever you do in this world, whether you're working for yourself or you're working for an employer, there is always risk involved. Choose risk accordingly. I had that picture in my mind of, becoming getting into my 60s and being stuck in a kitchen doing something that I hated. What's more riskier than that? I mean, I don't care how much money I lose in doing whatever, but to me, that picture was scary as hell. There was a lot of risk involved in that, and I didn't want to live my life that way. Now, how do you mitigate the risk? I remember being in the laundry room with my wife. It was around 2012, and I looked at her. I smelled like garlic. I just come home from the restaurant. And I said, Julia, I can't take this anymore. I need to leave New York and I need to get out of the restaurant business. And she looked at me, and in about 3 seconds, she said, okay. I was shocked that she actually said okay, but I think she looked at the pain on my face. Now, the reason why I'm telling you this story is what I proceeded to do after was to try to minimize the risk. At that point, I was all in with real estate. I said to myself, if my wife is giving me the grace and is giving me the permission to get into this venture full time, I need to give it my all. I need to learn and I need to dedicate time and become an expert in the craft of real estate. Forget about single family homes, forget about self storage, forget about Bitcoin, focus on multifamily. And I proceeded over the next 3 to 4 years to really become an expert in investing in real estate. That's probably the best tip that I can give you on minimizing risk, is to become an expert in whatever you're getting yourself into. Before you put that first dollar into an investment, exhaustive, join mentorships groups, go out there and learn how to become an investor, read tons of books, see what other people have done as far as becoming experts in that specific area. To me, that was the best thing. When she said yes, I couldn't let her down. And I knew that. And it's funny because she had confidence in me. She knew that I was going to work hard. So for me to know that, I'm like, I can't let her down. I can't let my family down. So that's why I plowed in. I even ended up opening up the Jake and Gino community because I knew that was a way for me to start learning. I started a podcast because Darren Gross told me it would be a great idea. I wrote a book. All of a sudden, I'm learning all of these things about real estate. That's probably one of the better ways to actually start mitigating the risks, is by becoming an expert in what you're doing. Ultimately, you're trying to avoid the downside risk. And then for us in the real estate space, we created that framework. And I work with frameworks, whether it's buy right, manage right, finance right, whether it's the 3 pillars of real estate, whether it's a negotiation framework that we use. You have to really understand to limit that downside risk. You're looking at it. And for us, to limit the risk is to have more of a long-term approach. If you're trying to do something with a short window and less time, there's more risk involved in something like that. But we know if we buy an asset, we buy it with good fundamentals. We buy it in a good market that's growing. If we are able to cash flow, put good debt on that, that's going to limit my downside risk going forward.
Yeah. No, well said. Gino, where can listeners go if they'd like to learn more or connect with you?
JakeandGino.com. That's where the real estate stuff is. We have our Jake and Gino podcast, and I have a how-to podcast. I have a company called Barbaro 360, Barbaro 360.com. That's a company that I started with my family. We want to really promote this whole family life, business coaching, money coaching. We want couples to be on the same page and to have those difficult conversations that they're not having about money. That's what's really lit me up over the last several years.
Awesome. Well, Gino Barbaro, I cannot say thanks enough for taking the time to talk today. I've enjoyed catching up, talking with you, and learning, and I look forward to doing it again soon.
Same here, brother. Thanks. Great seeing you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.